Hello and welcome to Uncovering Trusts, the Edison Group podcast where we explore interesting investment trusts and other listed closed-ended investment companies. I'm your host, Liam O'Byrne, and today I'm joined by Milos Paps, Director of Investment Company Content at Edison, to talk about Deutsche Beteiligungs, usually referred to as DBAG. Its Frankfurt ticker is DBAN. Milos, as always, great to have you with us.
Thanks, Liam. Good to be here. I think it's been more than 2 years since we last spoke about DBAG, so this is a good time to reintroduce it, I guess.
So, starting with the basics then, what is Deutsche Beteiligungs and how does it differ from other listed private equity vehicles we've covered before?
Yeah, so DBAG is a German-based listed private equity investment and fund management company. It invests in mid-sized companies in Germany and neighboring countries, mainly through management buyouts and growth capital financings. Its distinctive feature is a two-part model: balance sheet investments and fund investment services. DBAG invests alongside third-party investors in DBAG-branded private equity funds and, since acquiring a majority stake in Elf Capital, private debt funds as well. At the end of 2025, it had around 2.7 billion euros in assets under management and advisory, including DBAG's own investments, and generated 48.5 million euros of fund services income in FY25.
Great, thanks. That's a nice introduction to kick us off. So where does DBAG find its opportunities?
DBAG's sweet spot is the DACH private equity mid-market, so Germany, Austria, and Switzerland. Typically companies with enterprise values between 50 million and 250 million euros at entry. Now, importantly, many opportunities are family or founder-owned businesses facing succession questions, rather than assets already owned by other private equity firms. For instance, at the end of 2025, 25 out of DBAG's 37 holdings were previously family-owned or founder-led, which I think reflects its local network, research center, and in-house succession database.
And DBAG published a first quarter update in May covering the 3 months to the end of March 2026. Could you perhaps walk us through some of the key takeaways?
Yes, of course. The headline was a 3% decline in NAV per share to 35.29 euros, leaving the 12-month NAV total return at 0.4%. This was driven almost entirely by lower public market multiples used to value DBAG's unlisted holdings after the market sell-off around the Middle East conflict, with a negative 26.6 million euro valuation impact. Underlying portfolio company earnings momentum was positive, contributing 8.6 million euros. The company recently updated its FY26 NAV per share guidance to between 32 and 36 euros, down from 36 to 40 euros previously. It highlighted that this metric was impacted as of the reporting date primarily by the development of the valuation multiples of the peer companies. Its shareholders approved a €1 per share dividend at the June AGM.
You touched briefly there on the market sell-off around the Middle East conflict. How exposed is DBAG to the conflict and also the broader German economic backdrop?
Well, DBAG has no direct portfolio exposure to the region, but the conflict has weighed on market sentiment through lower listed company valuation multiples and a more cautious deal environment. Activity across global PE markets started picking up in the second half of 2025 and into early Q1 26, but the war in the Middle East resulted in a pullback in activity. However, I would note that KPMG recently said that with many markets back to pre-war levels, there is cautious optimism that the PE deal market will improve and result in a stronger year than expected, when the war started. I think that the potential for higher deal making is underpinned by the $1.3 trillion of global dry powder, most of which comes from funds raised in 2022 and 2023, so putting pressure on GPs to deploy capital. On the other hand, the possible turn in the US interest rate cycle may act as a restraining factor. Now, in terms of Germany, GDP rose just 0.2% in 2025, but expanded 0.3% quarter on quarter in Q1 2026. The IMF forecasts German GDP growth of 0.7% in 2026 and 1% in 2027, helped by infrastructure and defense spending.
Okay, great. And moving on to the portfolio itself, how has its composition evolved over time?
Well, the sector mix has changed materially over the last decade. At the end of March 2026, IT services and software was DBAG's largest sector at 29% of portfolio value, up from 24% at the end of 2025. Industrial and industrial technology followed at 21%, business services at 15%, environment, energy and infrastructure at 15%, and healthcare at 10%. That shift away from traditional industrials has been deliberate. Around a decade ago, industrial holdings made up roughly 80% of the portfolio. Now, today, DBAG's IT and software exposure is mostly in service-led businesses such as IT consulting, custom software, systems integration, and digital transformation. Management argues that this is less vulnerable to AI disruption than pure license software and may benefit from AI adoption. Portfolio holdings, Aquinet, Solvares, and Freiheit.com were all trading above budget in Q1. I would also note that the private debt through Elf Capital is another important change, representing around 12.7% of the portfolio, which is within DBAG's 10 to 20% target range.
What about leverage across the portfolio companies? Is that a concern given where rates have been?
It is worth watching, but to me, it does not look like an immediate pressure point. At the end of March, around 57% of DBAG's portfolio value sat in companies with a debt to EBITDA multiple of 4 times or more. The increase was mainly linked to Congatec's debt-funded acquisition of Jamtech rather than broad-based stress. Management says that there are no refinancing issues currently, and Carton Plus recently closed a 230 million euro infrastructure market refinancing, reducing borrowing costs and improving its maturity profile.
Okay, great. So we've discussed the portfolio composition and also the leverage across the portfolio companies. Could you maybe now talk about some examples of DBAG's recent investments that they've made?
Yes, with pleasure. In June, DBAG closed an investment in HIP Technology Group, acquiring a majority stake through a management buyout. HIP is a development partner and contract manufacturer in regulated medical technology with more than 80% of revenues from areas such as implantology, surgical instruments, and robotic surgery systems. It expects to generate around 95 million euros of revenues in 2026. What I found interesting is that the deal was sourced before a competitive process, helped by an introduction from the management of Kraft & Bauer, which is a former portfolio company of DBAG. And the value creation plan follows DBAG's usual playbook, so international expansion, add-on acquisitions, and operational improvements. Separately, in the same month, DBAG ECF4 fund agreed to acquire a majority stake in TNL Gruppe, an environmental planning and permitting consultancy for power line, wind, solar, and traffic infrastructure projects. I would also highlight DBAG's recent minority long-term investment in Bug Bounty Switzerland, which is a profitable cybersecurity testing platform combining ethical hackers with AI technology. Together, the deals reinforce DBAG's access to proprietary or bilateral opportunities.
Great. So DBAG has clearly had a busy start to the year. Has there also been activity on the disposal side as well?
Yes, very much so. The DBAG collected 86.4 million euros of realization proceeds in Q1 2026, equivalent to around 13.5% of opening NAV. The largest contributor was the duagon exit to Knorr-Bremse, which completed in January and delivered a multiple on invested capital of more than 2.7x. DBAG also completed the sale of Kraft & Bauer to Syngrowth Capital, generating a multiple of around 2 times after more than 7 years. Finally, DBAG agreed the sale of Mageba at around half of original cost, but in line with its last carrying value as part of its cleanup of all the industrial vintages. Several mature holdings remain in sales processes, including Freiheit.com, Green Data Hub, and Von Polymer Bedian, although IT and software disposals may be delayed until sector valuations recover.
With all that cash coming in, how does the balance sheet look?
Comfortably placed. At the end of March, DBAG had 61 million euros of financial resources, so cash and short-term investments, plus 91.5 million euro undrawn on its credit facility against 35 million drawn. So available liquidity was roughly 152 million euros, covering the majority of its 189 million euro of outstanding investment commitments. This liquidity also supported capital returns. As I've as I mentioned previously, there was the €1 per share dividend for FY25 was approved at the June AGM. And then on buybacks, the program was originally extended to the end of July, but by mid-June, the DBAG had effectively used the full €20 million authorization, repurchasing shares at an average price of about 25.03 euros. Because the shares trade below NAV, these repurchases should be NAV accretive for remaining shareholders.
Turning to performance and valuation then, how has DBAG done over the long term, and how does the market currently rate the shares as well?
Well, over the 5 years to the end of March 2026, DBAG's NAV total return in euro terms was 24.9%. This was ahead of the German small cap SDAX and the mid cap MDAX index, but behind the DAX, Stocks Europe 600, and the listed private equity peer average, largely reflecting the weak German macroeconomic backdrop. The share price has been weaker still, down 18.8% over the 5 years to March. So its shares now trade at a discount to a NAV of over 30%. But interestingly, before 2022, DBAG's shares traded at an average premium to a NAV of around 18%, which I think reflected the market valuing the fund services business, a value which is not captured in reported NAV. Given the portfolio's shift towards IT services, software, healthcare, and infrastructure-related sectors, plus private debt, the current discount to NAV may be considered wide.
Before we wrap up, can you also cover the fund services outlook, the dividend, and the cost structure?
Yes, of course. Fund services income rose modestly in Q1 2026 to 12.6 million euros from 12.1 million euros a year earlier, but EBITDA fell to 3.1 million from 3.8 million due to higher personal costs and placement fees. Management's FY26 EBITDA guidance stands at between 9 and 11 million euros, and management expects an increase to between 11 and 17 million euros by FY28 once fundraising begins for DBAG's next flagship management buyout fund, likely from late 2026, but depending on realizations from existing funds. On the dividend, the policy remains an annual payment of at least €1 per share. At recent prices, that equates to a yield of around 4.5%. I would note that DBAG is internally managed, so investors should consider the cost base together with the economics of the fund services platform rather than as a conventional external management fee model.
Fantastic. So to finish, then, how would you summarize the investment case for Deutsche Beteiligungs?
I would highlight 4 things. First, DBAG offers genuine diversification within listed private equity, as a DACH mid-market focus built on family succession deals. A portfolio that has shifted decisively away from traditional industrials and towards IT services, software, healthcare, infrastructure-related businesses, and private debt. Second, the fund services business is a real but underappreciated asset. DBAG manages or advises around 2.7 billion euros of assets, including its own investments, creating recurring, largely fee-based income. A business segment that does not show up directly in reported NAV. Third, the near-term picture is one of active portfolio rotation. DBAG has banked significant realization proceeds from Duagon and Kraft & Bauer. It is cleaning up all the industrial holdings, and it is redeploying capital into areas such as medtech, cybersecurity, and energy transition infrastructure services. And fourth, with the shares trading at a wide discount to NAV, the market does not appear to be fully recognizing either the quality of the portfolio or the value of the fee-generating platform. Investors should still watch the German macro backdrop, portfolio leverage, and the pace of exits, but DBAG has several levers to close the gap over time.
Miloš, thank you very much for that comprehensive introduction to Deutsche Beteiligungs.
Thanks, Liam.
You've been listening to Uncovering Trusts, a podcast by Edison Group. For more information on DBAG and other investment companies we cover, please visit www.edisongroup.com.